Burton G. Malkiel's A Random Walk Down Wall Street is one of the most influential books on investing. The book presents the idea that stock prices follow a random, unpredictable pattern, meaning that no one can consistently predict market movements. It emphasizes long-term investing, low-cost index funds, and diversification as the best strategies for building wealth. The book covers market history, different investing strategies, and behavioral finance, explaining why most attempts to beat the market fail. Below is a structured breakdown of the book's key ideas. Number 1. The random walk theory. Malkiel's random walk theory argues that stock prices move randomly and unpredictably. This means past price movements do not predict future prices, a key reason why many investors fail to consistently outperform the market. This challenges the effectiveness of technical analysis, which relies on price trends and patterns, as well as fundamental analysis, which focuses on company financials. Key takeaway: it's nearly impossible to consistently predict stock movements, so a passive investment strategy is best. Number 2. The efficient market hypothesis, EMH. Malkiel introduces the efficient market hypothesis, EMH, which states that stock prices already reflect all available information. Because of this, it is impossible to consistently outperform the market, even for professional investors. There are 3 forms of EMH. Weak form efficiency. Past prices and trends have no impact on future prices. Semi-strong form efficiency. All publicly available information, earnings reports, news, etc., is already priced into stocks. Strong form efficiency. Even insider information is already reflected in stock prices, though this is debated. Key takeaway: since stock prices quickly adjust to new information, trying to time the market or pick winners is usually futile. Number 3. The failure of active management. Stock picking and market timing do not work consistently. Many mutual fund managers fail to beat the market, even with research and advanced strategies. High fees from actively managed funds eat into investor returns. Studies show that low-cost index funds outperform actively managed funds over time. Key takeaway: instead of paying high fees for fund managers who rarely outperform the market, it's better to invest in index funds. Number 4. Popular investment strategies. Why they fail. Number 1. Malkiel analyzes different investing strategies and why they often fail. Number 2. Technical analysis, chart reading. Number 3. Uses historical price charts and trends to predict future movements. Number 4. Malkiel argues this is useless because prices move randomly. Number 5. Academic research has shown no evidence that technical analysis works in the long run. Number 6. Fundamental analysis, studying company financials. Number 7. Focuses on analyzing company earnings, growth, and financial health. Number 8. While useful, it doesn't guarantee market-beating returns because the market already factors in this information. The madness of crowds, speculative bubbles. Malkiel discusses financial bubbles, where irrational investor behavior inflates stock prices far beyond their value. Examples include: Number 1. Tulip mania, 1637. Dutch investors paid extreme prices for tulip bulbs before the market crashed. Number 2. The dot-com bubble, 1999 to 2000. Investors poured money into internet companies, leading to a massive crash. Number 3. The housing bubble, 2008. Speculative real estate investments triggered a financial crisis. Key takeaway: markets can be irrational in the short term, but they tend to correct over time. Number 5. The best investment strategy, passive investing. Why index funds are the best choice. Number 1. Malkiel strongly supports low-cost index funds like those that track the S&P 500. Number 2. Index funds consistently outperform most actively managed mutual funds because they have lower fees and track overall market growth. Number 3. Investing in a broad index fund reduces risk and ensures steady long-term growth. The power of diversification. Number 1. Never put all your money in one stock or sector. Number 2, invest across stocks, bonds, real estate, and international markets to lower risk. Dollar cost averaging. Number 1, invest a fixed amount of money regularly, regardless of market conditions. Number 2, this reduces the risk of bad timing and smooths out volatility. Key takeaway: passive investing in low-cost index funds, combined with diversification and dollar cost averaging, leads to the best long-term results. Number 6, behavioral finance: how emotions hurt investors. Malkiel explores psychological biases that cause people to make bad investment decisions. Number 1, overconfidence bias. Investors think they are smarter than the market. They trade too frequently, leading to high fees and lower returns. Number 2, herd mentality. People follow the crowd, buying overpriced stocks during bubbles and panic selling during crashes. Number 3, loss aversion. Investors fear losses more than they value gains, making them hold on to bad investments for too long. Key takeaway: stay disciplined, avoid emotional decisions, and stick to a long-term plan. Number 7, practical investment advice. Malkiel provides a step-by-step investment guide for building wealth. Step 1, start early and invest consistently. The earlier you start, the more you benefit from compounding interest. Step 2, choose the right investment mix, asset allocation. Young investors can hold more stocks, higher risk, higher reward. Older investors should shift to more bonds and stable assets. Step 3, invest in low-cost index funds. Choose broad market index funds, like S&P 500 or total market funds. Keep expense ratios low, below 0.5%. Step 4, avoid market timing. No one can predict market highs and lows. Stick to long-term investing and avoid emotional decisions. Key takeaway: follow a simple, disciplined strategy, index funds, diversification, and long-term thinking to maximize wealth. Final thoughts: why this book matters. A Random Walk Down Wall Street is a must-read for anyone looking to invest wisely. The book debunks common myths about beating the market. It shows that the best investment strategy is long-term, low-cost, and passive investing. Key lessons to remember: you can't predict stock prices. The market is efficient. Most information is already priced in. Stock picking and market timing rarely work. Index funds outperform most actively managed funds. Diversification and long-term investing are key. Final advice: stick to index funds, stay disciplined, and invest for the long haul. Avoid emotional decisions, speculation, and high-fee investments. Let compound interest and market growth build your wealth over time.